So in this refresher video, we'll go over the bond and stock characteristics, and then in the next video, you'll see the refresher for the risk-return trade-off and diversification. Okay. So what is a bond? A bond is a legally binding agreement, and it's an agreement between the borrower, so this is the person who's borrowing the money, and the lender. The lender is the person or entity that is giving you the money, and this agreement will specify it will specify a whole lot of other things, but the key things for us to keep in mind are it will specify the par value of the bond, so that's a face value. So that's a value that one would get back on the maturity of the bond, and the maturity date will also be disclosed in the agreement. It will also tell you what the coupon rate will be. So what is the percentage rate as a percentage of face value? So that's a regular periodic coupon you'll get. There will typically either be a fixed coupon, in which case it's a fixed rate bond, or it will be a floating rate coupon, in which case the coupon rate will be set by a formula. For example, they'll say, hey, the interest rate can be reset every 6 months at prime plus 2%, for example. Okay. So all of these payment details will be disclosed as part of this agreement. And keep in mind, this is legally binding, so you cannot get away from it. So this is a requirement that the borrower has to make all of these coupon payments and the par value repayment. Otherwise, the lender can go ahead and legally enforce the agreement. And typically, they will go ahead and force you to file for bankruptcy or some such. Now the yield to maturity, or the YTM, so this is the required rate of return on the bond, and this depends on the level of risk. And this is something that is required by investors in the marketplace as compensation for the risk of the bond. So the more risky the bond, the higher is going to be the yield to maturity, so the risk premium is going to be higher. So the risk premium is nothing but the return in excess of the risk-free rate. So if let us say the risk-free rate is 3%, and this bond is giving you a return of 5%, then the risk premium is the yield to maturity on this bond, 5%, minus the risk-free rate of 3%, so your risk premium is 2%. If the bond is more risky, then the risk premium will be higher, so maybe it will be like 4%, in which case the yield to maturity on the more risky bond will be the risk-free rate of 3% plus the risk premium of 4, so the total yield to maturity would be 7%. Now we can value all the bonds as the present value of all future cash flows. So we know that the future cash flows are going to be these regular coupon payments, which are going to occur most often on a semi-annual basis, and you will get this par value that's going to be repaid on the maturity date of the bond. And we can go ahead and calculate the present value of all of those future cash flows discounted at this yield to maturity, and that present value should be the value of the bond. Now when we go ahead and look at bond valuation, I'll ask you to explain why. So spend the next few weeks thinking about why this present value should equal the price or value of the bond. Now keep in mind, the interest rates are going to be, the discount rate is going to be inversely related to present values or bond prices. So the higher the required rate of return, the lower is going to be the present value, the lower is going to be the bond price. So here's an example. So let's suppose we have a US government bond. Interest rate coupon is 6 3/8%. The bond is going to expire on December of 2013, and we are going ahead and doing the valuation on January 1 of 2009. So you have basically 5 years to maturity, and the coupon payments are going to be made on a semi-annual basis every June end and December end. The par value, and this is quite common, the par value for the bond is 1,000. The coupon rate is 6 3/8, so this is an annual coupon rate. So you're going to pay 6 3/8% of this par value every year, but the bond is going to make semi-annual payments, so each semi-annual payment will be half of that, which is 31.875. So we can go ahead and plot this on a timeline. The time 0 is today, which is the end of December 2008, or the beginning of Jan 2009. This is pretty much the same thing. And the size and timing of these cash flows are known, predictable, because all these are determined by these coupon rates and the face value and the maturity date. So we know all the dates. So you're going to get this coupon payment every 6 months all the way until maturity, and on the maturity date you will get this face value 1000 back, plus you will get the last coupon. So you can go ahead and calculate the present value of all of those future cash flows. So you can use the present value formula if you want to. You could do that, or you could use your financial calculator. You could use Excel. So plug in all the values. So this is a semi-annual bond. So the coupon is paid on a semi-annual basis. The maturity is 5 years. So there are 10 semi-annual periods. So I'm going to put n of 10. Your semi-annual payment is 31.875. So your semi-annual payment is 31.875. Your future value is 1000. That's what you're going to get on the maturity. Keep in mind, this last coupon payment is part of this payment. Okay, so that shows up here. Now, if the yield to maturity on this bond is 5% per year, so for every 6 months, keep in mind these cash flows are semi-annual. So this is semi-annual compounding. So your discount rate has to be semi-annual. So that's 2.5%. And then I can calculate the present value as 1060.17. So this will be the price of the bond, the clean price of the bond as of 1st January 2009 or December 31st, 2008. Now what happens if the interest rates go up in the marketplace? So instead of being 5%, the interest rate increased to 11%. So you can go ahead and take the semi-annual rate as 5.5%. So this is annual rate. So semi-annual rate will be 5.5%. Plug in the values and you will see the bond price is lower. So as the discount rate has gone up, the required rate of return has gone up, the present value of the bond price has come down. So they move in opposite directions. So you can calculate the yield to maturity. So if, let us say, instead of giving you the yield to maturity and asking you to calculate the price, we can tell you the price is so much, and then you can simply calculate the yield to maturity. Okay, and keep in mind that has to be on an annual basis. Okay, so this yield to maturity is what is required by investors in a marketplace, and the required rate of return depends upon how risky the bond is. Typically, US Treasuries, they are considered risk-free, so they'll have the lowest rate. But once you go to the highly rated corporate bonds, so they can be like a AAA rated or a AA rated bond, they are a little bit more risky than the treasuries because these are default free. There will be a small probability of default here. So there will be a small risk premium added to this risk-free rate. So the yield to maturity or the required rate of return here is going to be slightly higher. Lower rated corporate bonds, maybe even junk bonds, so they are even more risky, so their risk premium is going to be even higher, so their required rate of return will be even higher. So keep in mind, the risk premium is just the difference between the risk-free rate and the risky discount rate. Okay, that's a risk premium, that's a difference. Now, what is a common stock? Common stock represents a unit of ownership. So they have a residual claim. That means they get paid at the very end after all the other claim holders have been paid. So they can only get whatever is left over. And therefore, their claims are typically more risky than the claims of the bondholders, the corporate bondholders, because the bondholders have to get paid first. Their level of risk is a little bit lesser than that of equity. Now, when you talk of values, typically we'll be interested in market value or price. Accountants look at book value a lot. That's from the balance sheet. So that is not the market value or the market capitalization of the firm. So that's not the true value of the firm. Others also talk about what is the replacement cost. Typically, if you have a lot of fixed assets and real estate and stuff like that. But we are going to be pretty much focused on the market value of price for all of our asset pricing stuff. So there are other features of common stock which we are not going to worry about too much. Things like the voting rights, different classes of stock. Many shares trade as dual class stocks, for example, Ford, Google, and so on. we're not going to worry a whole lot about them. Okay, so equity valuation is a separate class, so we're not going to worry about that here. Now, typically, whenever you invest in any asset, there are going to be two ways you'll get a return. One is going to be a cash flow return. That's going to be either from dividends if you are investing in stock, or through the coupon rate if you are investing in a bond. Okay, so you're going to get some cash flows. The second way you can get a return is through a change in price. Okay, that's called the capital gains or capital appreciation. So the total return you get is going to be the sum of whatever dividends or interest you get plus whatever is the price change. Okay, now because the cash flows on common stock are the residual, they are not exactly set in advance. For example, with a bond, we know what cash flows you're going to get and the timing and the dates. We don't know that for stock. Okay, so the return that you're going to earn on the stock is obviously going to be less reliable. That means they're going to be more risky as compared to bonds. Okay, now this is basically a quick refresher on what is a stock, what is a bond, and some other key characteristics. Again, if you want more details, you can look at your 520 textbook. If something is unclear, you can email me, you can post it on Moodle, or you can ask during the class or during the office hours in any way. Okay, but make sure that if you have any questions, you get them answered at the earliest possible.